Hello students, I am Kamaljit Sharma, PGT Accountancy, teaching in Cambridge International School, Dasuya. This lecture is prepared for the subject of Business Studies for Grade 11 Commerce. In this chapter, number 4, that is Business Services, the topics to be covered like characteristics of services, then distinguish services from goods, classify different type of business services, then the concept of e-banking, then identify and classify different types of insurance policies, and describe different types of warehouses. Dear students, in the previous session we studied about the telecom and postal services from chapter 4. Today we will study about the insurance services. I hope this session would benefit you in understanding the concepts. Students, now discuss about Indian insurance sector. It is a well-known fact that Indian economy has been amongst the fastest growing economies of the world. It is triggered by better performances of all the three sectors, that is agriculture, industry and services. With an increase in manufacturing and service sector activities are directly proportional, higher insurance penetration is need of the hour. With the initiation of financial sector reforms, the Indian insurance sector, which was till now under the government control, has to set open for competition to meet the global challenge. The first step taken by government was to establish IRDA Act with the objective of streamlining the development process. The Indian insurance market is a mega market with a huge potential. Since the opening of the insurance sector in December 1999, the insurance industry is changing rapidly. Today, 13 companies operate in the life and 13 in non-life segment. LIC of India has dominated the life segment for over 4 decades, although only 25% of the insurable population was insured. From the year 2000 onwards, IRDA started granting licenses to private players. Thus, general insurance sector has been considerable expansion over the past few years. The premium income has recorded a growth rate of 20%. A department-wise split shows that in the year 2002-2003, 21% of the business is derived from fire, 9% from marine insurance, 39% from motor insurance, 8% from health insurance schemes, 5% from re-engineering, and remaining 18% from other miscellaneous insurances. Amongst the fastest growing companies are the National Insurance, Bajaj Allianz, Tata AIG, and ICICI Lombard. Currently, over 70% of the business underwritten, that is fire, marine, motor, and engineering, is subject to tariff controls. Now, what is insurance? Students' life is full of uncertainties. The chances of occurrence of an event causing losses are quite uncertain. There are risks of death and disability for human life, fire and burglary, risk from property, perils of the sea for shipment of goods, and so on. If any kind of these takes place, the individuals or organizations may suffer a great loss, sometimes beyond their capacity to bear the same. It is so to minimize the impact of such uncertainties that there is a need for insurance. Investment in factory buildings or heavy equipment or other assets is not possible unless there is an arrangement for covering the risk with the help of insurance. Keeping this in mind, people facing common risk come together and make a small contribution to a common fund, which helps to spread the loss caused to an individual by a particular risk over a number of persons who are exposed to it. Insurance is thus a device by which the loss likely to be caused by an uncertain event is spread over a number of persons who are exposed to it and who prepares to insure themselves against such an event. It is a contract or agreement under which one party agrees in return for a consideration to pay an agreed amount of money to another party to make a loss, damage, or injury to something of value in which insured has a pecuniary interest as a result of some uncertain event. The agreement or contract is put in writing and is known as policy. The person whose risk is insured is called insured, and the firm which insures the risk of the loss is known as insurer or assurance underwriter. Now we will discuss the fundamental principle of insurance. The basic principle of insurance is that an individual or a business concern chooses to spend a definitely known sum in a place of a possible huge amount involved in an indefinite future loss. Thus, insurance is the substitution of a small periodic payment, that is premium, for a risk of large loss. The loss of risk still remains, but the loss is spread over a large number of policyholders exposed to the same risk. The premium paid by them are pooled, out of which the loss sustained by any policyholder is compensated. Thus, risks are shared with others. From the analysis of past events the insurer, an insurance company or the underwriter, knows the probable losses caused by each type of risk covered by insurance. Insurance, therefore, is a form of risk management primarily used to safeguard against the risk of potential financial loss. Ideally, insurance is defined as the equitable transfer of the risk of a potential loss from one entity to another in exchange for a reasonable fee. Insurance companies, therefore, is an association, corporation, or an organization engaged in the business of paying all legitimate claims that may arise in exchange for a fee known as premium. Insurance is a social device in which a group of individuals, that is insured, transfers risk to another party, that is insurer, in order to combine loss experience, which provides for payment of losses from funds contributed by all members. Insurance is meant to protect the insured against uncertain events which may cause disadvantage to him. Now we will discuss some functions of insurance. The first function is providing certainty. Insurance provides certainty of payment for the risk of loss. There are uncertainties of happenings, of time, and amount of loss. Insurance removes these uncertainties and the assured receives the payment of loss. The insurer charges premium for providing the certainty. The second function is protection. The second function of insurance is to provide protection from probable chances of loss. Insurance cannot stop the happening of a risk or event, but can compensate for losses arising out of it. Third function is risk sharing. On the happening of a risk event, the loss is shared by all the persons exposed to it. The share is obtained from every insured members by way of premiums. The fourth function is assist in capital formation. The accumulated funds of the insurer received by way of premium payments made by the insured are invested in various incomes for income generating schemes. Now we will discuss principles of insurance. The principles of insurance are the rules of action or conduct adopted by the stakeholders involved in insurance business. The specific principles of utmost significance to a valid insurance contract consist of the following. The first principle is utmost good faith. A contract of insurance is a contract of abrame fidei, that is, a contract found on utmost good faith. Both the insurer and the insured should display good faith towards each other in regard to the contract. It is the duty of the insured to voluntarily make full, accurate disclosures of all facts material to the risk being proposed, and the insurer to make clear all the terms and conditions in the insurance contract. Thus, it is binding on the proposer to disclose all material facts about the subject matter of proposed insurance. Any fact which is likely to affect the mind of a prudent insurer in deciding to accept the proposal of insurance or in fixing the rate of premium is material for this purpose. Failure to make disclosure of material facts by insured makes the contract of insurance voidable at the discretion of the insurer. The second principle is insurable interest. The insured must have an insurable interest in the subject matter of insurance. One fundamental principle is that it is not the house, ship, machinery, potential liability of life that is insured, but it is the pecuniary interest of the insured in them which is insured. Insurable interest means some pecuniary interest in the subject matter of the insurance contract. The insured must have an interest in the preservation of the thing or life insured so that he or she will suffer financially on the happening of the event against which he or she is insured. In case of insurance of property, insurable interest of the insured in the subject matter of the insurance must exist at the time of happening of the event. In order to name insurable interest, however, it is not necessary that one should be the owner of the property. For example, a trustee holding property on behalf of others has an insurable interest in the property. The third principle is indemnity. All insurance contracts of fire or marine insurance are contracts of indemnity. According to it, the insurer undertakes to put the insured in the event of loss in the same position that he occupied immediately before the happening of the event insured against. In other words, the insurer undertakes to compensate the insured for the loss caused to him or her due to damage or destruction of property insured. The compensation payable and the loss suffered are to be measured in the terms of money. The principle of indemnity is not applicable to life insurance. The next principle is proximate cost. According to this principle, an insurance policy is designed to provide compensation only for such losses as caused by the perils which are stated in the policy. When the loss is the result of two or more causes, the proximate cause means the direct, the most dominant and most effective cause of which the loss is the natural consequence. In case of loss arising out of any mishap, the most proximate cost of the mishap should be taken into consideration. Next principle is subrogation. It refers to the right of the insurer to stand in the place of the insured after the settlement of the claim as far as right of insured in respect of recovery from an alternative source is involved. After the insured is compensated for the loss or damage to the property insured by him or her, the right of ownership of such property passes on to insurer. This is because the insured should not be allowed to make any profit by selling the damaged property or in the case of lost property being recovered. The next principle is contribution. As this principle, it is the right of an insurer who has paid claim under an insurance to call upon other liable insurers to contribute for the loss of payment. It implies that in case of double co-insurance, the insurers are to share the loss in proportion to the amount assured by each of them. In case there is a loss, when there is more than one policy on the same property, the insured will have no right to recover more than the full amount of his actual loss. If the full amount is recovered from one insurer, the right to obtain further payment from the other insurer will cease. The next principle is mitigation. This principle states that it is the duty of the insured to take reasonable steps to minimize the loss or damage to the insured property. Suppose goods kept in a storehouse catch fire, then the owner of the goods should try to recover the goods and save them from fire to minimize the loss or damage. The insured must behave with great prudence and not be careless just because there is an insurance cover. If reasonable care is not taken, like any prudent person, then the claim from the insurance company may be lost. Now the time for homework. Dear student, in this session we have discussed about the insurance services and the functions of insurance. I hope this session would be beneficial for you. In the next session, we will continue our next topic. Till then, dear students, to stop the COVID 19, stay home. If you don't think about yourself, think about your loved ones. So stay home, please. But study regularly.